If you're new to trading, you've probably seen lines on a chart called EMA and wondered what they actually mean. In this video, I'll explain what EMA is, why traders use it, and what it tells you about price in plain language. What EMA means. EMA stands for Exponential Moving Average. A moving average is simply the average price over a certain number of periods. For example, a 20 EMA shows the average price of the last 20 candles. A 50 EMA shows the average price of the last 50 candles. Why EMA exists. Markets move fast. Old prices matter less than new prices. What makes EMA different is this: it gives more importance to recent price. That means EMA reacts faster to price changes than other moving averages. What a market actually is. Before indicators, understand this. A financial market is an auction. Buyers bid, sellers offer. Price moves to the level where transactions agree. Price changes because demand and supply shift, not because indicators tell it to move. Indicators are tools for interpretation, not prediction. Okay, let's break it down one more time. What is EMA and how is it used?
An exponential moving average, EMA, is a statistical measure used in financial markets to smooth price data over time while assigning greater weight to more recent observations. Unlike a simple moving average, SMA, which treats all historical prices equally within a given window, the EMA reflects the principle that recent market activity contains more relevant information than older data. Formally, the EMA is a recursive function in which today's value is derived from yesterday's EMA and today's price, adjusted by a smoothing factor related to the chosen lookback period. However, from a market behavior perspective, the EMA is best understood not as a formula, but as a dynamic reference point for collective market behavior.
Put simply, an EMA is a way of showing where price has been spending most of its time recently. Instead of reacting to every small price change, it smooths those movements so we can see the general direction the market is moving in. The key idea is that recent prices matter more than older ones. What happened yesterday tells us more about current market conditions than what happened weeks ago. The EMA reflects this by staying closer to current price and adjusting as new data comes in. In practical terms, the EMA acts like a moving benchmark. When price stays above the EMA, it suggests that buyers are comfortable paying higher prices and that upward momentum is present. When price stays below the EMA, it suggests that sellers are in control and that the market is rejecting higher prices. Rather than predicting where price will go next, the EMA helps us understand what the market is currently accepting. It provides context, whether price action is strong, weak, or uncertain, by summarizing recent trading behavior into a single, easy-to-interpret line.
Although EMAs are mathematical averages, their importance in financial markets does not come from the calculation itself. Markets move because people and institutions make decisions, and many of those decisions are guided by shared reference points. EMAs matter because they are widely used by large market participants, such as hedge funds, asset managers, and systematic trading programs when managing risk and allocating capital. These participants often follow predefined rules that reference moving averages to decide when to increase exposure, reduce risk, or rebalance portfolios. For example, an institutional risk model may reduce equity exposure when prices fall below a certain moving average, or increase exposure when prices remain above it. Similarly, hedging strategies often adjust dynamically as price approaches or moves away from key EMAs. As these actions occur, they generate real buying or selling pressure in the market. Because many participants monitor the same EMA levels, their collective behavior tends to converge around those points. This leads to increased trading activity near EMAs, causing price to pause, react, or change volatility characteristics. Over time, this repeated behavior gives EMAs a structural role in market dynamics. Importantly, EMAs do not predict future prices. Instead, they become self-reinforcing reference levels because market participants act in similar ways when price interacts with them. The EMA reflects behavior first, and price reactions follow as a consequence of that shared behavior. In this way, EMAs function less as forecasting tools and more as coordination mechanisms. They summarize how risk is being perceived and managed across the market at any given time.
Think of EMAs as a way to see the mood of the market. They tell us whether risk is being accumulated, people are willing to buy and hold; being maintained, people are holding steady, not changing much; being reduced, people are selling or stepping back. When price stays above an EMA, It shows that the market accepts higher prices and participants are comfortable taking on risk. When price drops below an EMA, it signals that the market is less willing to support these prices and risk is being reduced. Instead of just asking, is price going up or down, EMAs let us ask a more useful question. Is the market confident enough to hold or increase risk at this level? This helps us understand the bigger picture and decide how to act, rather than just following short-term price moves.
Think of EMAs as moving reference lines instead of fixed numbers on a chart. They move with price, so they reflect how the market's view of fair value is changing in real time. When price gets close to an EMA, many traders and institutions pause and make decisions. Some may buy, some may sell, some may hedge. This creates increased activity around the EMA. It's important to understand, EMAs are not magic support or resistance. Price can break through them easily. What they really show are areas where people are paying attention and acting. In other words, EMAs highlight zones of concentrated decision-making. If you trade with that knowledge, you can act where the market is more predictable, instead of guessing blindly.
Before we dive into the details, ask yourself this. If I see price moving up, how do I know whether the market is genuinely confident or if it's just a short-term spike that could reverse? This is exactly what the slope of an EMA tells us. It's not just about whether price is rising or falling. It's about how committed the market is to that move and whether risk is being accepted or avoided by participants. By observing EMA slope, you can filter noise from meaningful trends, identify where momentum is strong, and anticipate where pullbacks are likely or dangerous. Let's break it down.
A steadily rising EMA indicates that buyers consistently dominate, absorbing sell orders without allowing price to drop significantly. It reflects stable risk tolerance. Market participants are willing to maintain or add positions. Practically, this signals that pullbacks are likely to be shallow, making bullish strategies, like bull put spreads, statistically safer when strikes are positioned below the EMA.
When the EMA flattens, buying and selling pressure is roughly balanced. This represents a pause in trend momentum, often caused by uncertainty about fundamentals, news, or macro conditions. Flat EMAs are often precursors to volatility spikes because the market is searching for a new equilibrium. Traders who ignore this risk can get whipsawed in short-term moves. Actionable insight: avoid placing spreads with tight risk margins when EMAs are flat. The market can move unpredictably across your strike zone.
A declining EMA reflects selling pressure dominating buying. Market participants are actively reducing risk or reallocating capital, often leading to acceleration and downward moves. Even temporary bounces in price may fail near short-term EMAs because the slope indicates that structural support is weakening. This is a warning. Bullish premium selling strategies are now higher risk, as the probability of the short put being challenged increases.
Slope plus distance equals trend quality. The EMA slope must always be interpreted relative to how far price is from the EMA. Price far above a rising EMA, trend is strong but stretched. Watch for mean reversion. Price hugging a rising EMA, trend is healthy and sustainable. Price below a rising EMA, early warning that trend strength is failing.
What EMAs do not do? They do not forecast. EMAs react to price. They confirm, they do not anticipate. Anyone saying EMA says price will go up is guessing. They are not trade triggers. A cross by itself is meaningless. Context, slope, distance, volatility, structure is what gives it weight. They do not remove risk. They reduce uncertainty, not loss. Risk still comes from volatility expansion, news, and regime shifts. EMAs don't tell you what will happen. They tell you how fragile or stable the current state is.
All right, now let's talk about a bullish strategy and a bearish strategy, and how to recognize each one before you ever put money at risk. A bullish moment is when the 50 EMA crosses above the 200 EMA. But before entering, check that the 50 EMA slope is rising. This shows the market is committed to higher prices. Look for price to pull back into a bullish order block overlapping the 50 EMA. This is where smart money may defend their positions. Confirm momentum with MACD. The histogram should be positive and rising, and the MACD line above the signal line. When all three line up, that's your high probability bullish entry. And a bearish moment and what to watch for. A bearish moment is when the 50 EMA crosses below the 200 EMA. Before entering, make sure the 50 EMA slope is falling. Sellers are in control. Watch for price to rally into a bearish order block overlapping the 50 EMA. This acts as resistance. Confirm momentum with MACD. The histogram should be negative and falling, and the MACD line below the signal line. Once all three align, that's your high probability bearish entry.
That wraps it up. If this gave you a cleaner way to read the EMA and understand market behavior, leave a like. It tells me this level of depth is worth continuing. Subscribe if you want disciplined analysis, real risk awareness, and no prediction games. If there's a topic you want covered next, leave it in the comments. I read them and build from there. Stay patient, manage risk. I'll see you in the next one.